people maximize their financial plans. So what I'm going to share with you guys today is a little bit about whole life insurance, how dividends work, and also a little bit about how you can utilize that to diversify your overall financial plan. I'm very open to any comments you guys have, any questions you have throughout the presentation. Feel free to drop a question in the chat if there's anything that you're not sure about that I'm talking about. And either Quinella or Diana can stop me and I can kind of go a little bit deeper into whatever it is that you're not sure about. But without further ado, I will get started. Are you guys able to see my screen here?
Yes.
Yes?
Yes, we are.
So I'm going to address the 6 key areas of capital accumulation and protection. I think this is an important place to start when we're talking about the uses of whole life insurance. And the reason being, when it comes to diversification and capital accumulation, this is somewhere where you can either optimize your plan and, within your means, whatever they may be, you can optimize that using things like cash value life insurance to give yourself a buffer asset. Or sometimes if you don't optimize it, you can really leave yourself open to certain risks that we don't always think about. So the goal here is to maximize gains and minimize risk. The 6 key areas we're going to talk about are income protection. A lot of us don't realize when we think about our greatest asset, a lot of times we think about our real estate portfolio. And for some of us, that might be the key, the truth. But for most of us, our income is our biggest asset. So protecting that, capital risk, right? Income tax risk, which unfortunately is one of those things that when it comes to planning, we can't always know exactly what type of role that's going to play in our plan. The highest ever tax rate in the United States was just above 90%. That was back in the 60s and 70s. So right now, as much as we pay in taxes, we're actually at a historically low point for taxes. So unfortunately, they probably only go up from here. Asset protection, retirement planning, and then estate planning are the 6 things we're going to talk about today. So first, income protection. Like I mentioned before, this is, for most of us, our biggest asset. Things like Quinella was mentioning before. Unfortunately, death, disability, and illness can cause a big loss to our income. And one of the things that we don't always realize is the first thing to go when we lose our income is capital appreciation and saving for the future. A lot of times our concern is now paying the bills. It's, how are we going to put food on the table, getting by, rather than accumulating wealth and leaving a legacy behind to the next generation. So that's one of the focuses we have when we use life insurance as an asset. Does that make sense? So when it comes to capital asset risk, this is the second thing I was talking about before. When we think about our assets, we're thinking about stocks, bonds, real estate, treasuries. We have various risks in each of these scenarios. Diversification of our assets is one of the most important techniques we can use to make sure that we're going to optimize our returns long-term and balance out our risk. So the best way I can describe this is if we're invested very heavily in any one area of capital assets, for example, if we're all in stocks or we're all in real estate, if that area for some reason takes on big losses, it can affect us very heavily moving forward. Especially in retirement, there's something called the aggregation of risk. So when I'm looking at, let's say, the stock market, if I have heavy losses in the stock market, but in retirement, I'm pulling from my stock account while it's down, then for every dollar I'm pulling, it's like pulling $2 the year before. So similar to real estate, let's say during COVID, when there was a kind of a moratorium on rent and certain people didn't have to pay rent, Well, now, if you're heavily invested in real estate, you can take on heavier losses than you would normally be prepared for. That's why it's important to diversify and have a little bit in different areas to make sure that we're able to take on heavier risks and not lose a higher portion of our assets than we're prepared for. Now, especially for business owners, your business is one of your assets. A lot of times business owners don't really think of their business as an investment because they're tied so closely to it. But it definitely is, you being heavily invested in one specific asset. So you should still think about risk diversification as a priority and start considering what is your exit plan for your business, which is a major way we use life insurance when it comes to business owners, is helping them develop an exit strategy. One area we use this for is, let's say I have a hair salon and I've looked into selling it. I can't really get what I would want to sell it, but I have a pretty consistent book of business. I know I really don't want to be in the salon forever. I want to eventually retire. And I have somebody that I trust that could run the business, but they wouldn't necessarily have the assets to be able to purchase the business from me. We can sometimes use life insurance as a way to be able to purchase a business from somebody else, which is fantastic. Income tax reduction. To accumulate capital effectively, you really want to be able to lower income taxes as much as possible. 4 major ways to do that: deduct expenses, which we know; defer income, which is another way we sometimes use cash value life insurance; divert income to others; and then convert taxable income into non-taxable income. So obviously, you should definitely talk to an attorney about this. I know we have, who was our attorney we had on here? Oh, I'm sorry, who was our CPA?
Yes, someone on here said they were a CPA. I think it was Nicole.
I was going to say Nicole. So if you want to know more about some of those things, you can definitely ask Nicole. You can, you want to work with a tax professional, but it's important to understand how you can reduce your taxes while you're working, and especially in retirement, to be able to keep more of your money. The way we talk about this is most people focus on accumulation of wealth. If all you focus on is accumulation and you don't focus on how you can distribute that wealth later on in a tax efficient way, it doesn't matter how much you can accumulate because you're going to wind up giving most of it back to the government. Asset protection. A big way that we're able to utilize life insurance is, especially within trusts, making them exempt assets under state and federal law, limiting your liability in certain cases, and putting them into with corporations and limited liability organizations, having them set up through them. This way you can kind of limit your risk of your assets. And then retirement planning. 3 major ways to accumulate capital for retirement: qualified retirement plans, non-qualified retirement plans, which are 401ks, Roth IRAs, and then after-tax accumulations. So one of the biggest things I'm going to talk about today when it comes to cash value life insurance is how we can use that as a way to grow tax-free assets and then access our wealth tax-free, also leaving it tax-free to the next generation. And then finally, estate planning. This is something that's a little bit different for everybody, but when it comes to estate planning, if you think that you're going to have a large enough estate that you're going to have to pay estate taxes, or you want to protect your estate or reduce or minimize federal and state estate taxes, you really want to think about setting up a trust with a life insurance policy that can pay some of those estate taxes, minimize your tax bill, and protect you from things like a long-term care event, that can healthcare in retirement that can sometimes really have a big impact on your estate with or without estate taxes. So I know that was a lot to throw at you quickly, but my point in going over those things are those are some of the reasons that we use cash value life insurance in our everyday financial planning needs. The next thing I'm going to go into is how do we use whole life insurance and what makes it so special? So to give you a very quick, simple understanding of life insurance, there are two ways whole life insurance can grow: guaranteed cash value, and then dividends that also offer potential growth. So you have a life insurance policy, you pay into it every year, but how does it grow? Why not just put that money into a savings account? So within your life insurance policy, you're going to have a guaranteed interest rate, and then you're going to have a dividend that's not guaranteed. But with a company like New York Life, we've been around for 178 years. We've paid a dividend for 170 consecutive years. So even though it can't be guaranteed, we've never missed one since paper money's been around. So you have the guaranteed death benefit, you have your premium, you have a guaranteed interest rate, and then you have what's called paid up additions. So what happens is we take the dividend, we use the dividend to purchase more insurance. After the dividend purchases more insurance, your cash value has then grown. You have now more life insurance. Now the next year, you're going to get an even bigger death benefit. You're going to then get an even bigger dividend. And that process is going to continue year after year. So your total death benefit is going to typically grow by 2 to 5 times your premium. You're going to get a dividend every year that's going to compound tax-free and make the policy grow more and more each year. So you get compound growth out of it. After, let's say you've gotten to the point now where you want to pull from your policy. Let's say you have a savings account and I have $100,000 in my savings account. If I pull $20,000 out of that savings account and I only have $80,000 left, I'm only going to earn interest on that $80,000. With your cash value life insurance policy, if you have $100,000 in that policy and you pull out $20,000, your dividend is still going to grow as if there was $100,000 in that policy. So another way that cash value life insurance winds up being an asset is rather than when I pull my money out, I only have, let's say, $80,000 left, and I'm only earning on $80,000. I'm still earning that dividend on the entire $100,000, even though I've pulled a portion of it out. So that's my basic explanation of how life insurance works. The last thing I want to share with you guys before we go to question and answers is what I call the wheel of benefits. So the reason we use this is it provides a guaranteed death benefit. Premiums are guaranteed to never increase, so I can use it as a permanent part of my financial plan. The cash value within the policy is going to grow tax-free, and I'll be able to access that money tax-free later on. So it's going to grow tax-deferred, and I can now access it tax-free. Some of the ways we use this is protection from creditors. You're able to access that money with no credit check. You have guaranteed cash accumulation growth, and it's going to be an asset class alternative to your bond portfolio. So the mistake some people make when talking about cash value life insurance is, well, why would I use a life insurance policy, a whole life policy that's going to grow by maybe 6% per year when I can invest in the S&P 500 or real estate and I'm going to get 20% gains, 12, 15% gains? That's not what we're using whole life for. This is an alternative to your savings account. So you never need a savings account. This is an alternative to your bond portfolio. So you don't need the other safe investments that you would use. You can use instead a whole life policy that'll give you the same thing with some added benefits. We're definitely not trying to replace your 401k or replace your S&P 500, ETF or your real estate portfolio. This is all in addition to. But at this point, that's all I have. I would love to know some of your feedback, some questions you guys may have that I can help you understand maybe a little bit further.
Hi, Erik. Thank you. Hi, everyone. I'm Diana, and Erik is my partner. I'm Diana Theodore. I'm an agent with New York Life, and I hope everyone gathered lots of information. I wanted to just have you go into a little bit more detail of how to use whole life. Like, let's say for me, for instance, I love traveling, right? You guys know that. And so if I am starting out and I wanted to have coverage for me and my family, but I also have a financial event that I cover, how would life insurance, how would I utilize it? How would it benefit me? What other ways you could break that down, Erik?
Sure. So I missed a little bit in the middle. You broke up a little bit. Your question that I got was basically if you have goals like you want to travel, you want to be able to utilize some, your money while you're alive and while you're living, but you
Right.
also have protection needs. How can you utilize life insurance?
Right.
So great question, Diana. The whole purpose of utilizing something like life insurance, as opposed to certain other things like bonds or other safe assets, is the long-term liquidity it gives you to be able to use your money while you're still alive without feeling bad about it. So a lot of people don't give themselves access to their retirement money because I need that money to grow. I need to be able to use it later on. Well, with the life insurance policy, you're able to have that protection. So God forbid something happens to you, you're able to leave a healthy death benefit behind to your loved ones and create that legacy. But you're also able to utilize that cash value while you're alive to do things like traveling, and know that even if I pull some of my money out of this, it's going to continue growing as if I didn't. So it kind of gives you that, pain-free access to your cash value without worrying about how you're going to hurt yourself in the future. Great question.
And Erik, there's a question not asked, are we using cash value and whole life interchangeably?
Yes. So cash value life insurance is whole life. It can also be other types of life insurance. So there's variable universal life. There are many different types of life insurance that build cash value. But yes, whole life is one of the main ones we use because of how it grows based on dividends.
And I also wanted to ask, because when I came into the industry, I did have a policy myself prior to New York Life, but I didn't understand like the terminology, like dividends, and I knew what a premium was, but a dividend, I wasn't too sure. And so like if you can explain that a little bit.
Sure, absolutely. So another great question. One of the things I think that probably goes misunderstood a lot of the time is, why do I get a dividend? So New York Life is a mutual company. What that means is the policy holders in the company are owners of the company. So our policy holders are our owners. You can't go out and buy New York Life stock. So every year, New York Life, states a dividend, and as an owner in the company, you're entitled to a dividend of the company. That's how it's grown, and the dividend grows year after year. So one of the benefits to using a big company like New York Life is we always pay our dividend. We have the highest possible financial strength ratings. We really love those ratings. So if we didn't pay a dividend, we would lose those ratings. So we're highly motivated to pay those dividends year after year.
And looking at the chat, Na also asked, would the money need to be paid back after withdrawal? You could answer that. But...
Great question. No, the money never needs to be paid back. That's one of the benefits of using the policy is the money you borrow from it, you never have to pay back. It gets settled when you pass away, when the death benefit gets paid out. That's why you generally are not going to access more than 95% of the cash value in the policy, because keeping the policy open means that you never have to pay that policy back, but you'll continue getting a dividend year after year.
But they have the option to pay it back if they wanted to and keep their
Correct.
same benefit, right?
Yeah, so you could pay it back if you wanted to, and that would help your dividend grow by more year after year.
Okay, not again. Girl, you're on fire today. Are there certain categories for which you can make withdrawals while you are living, or are there restrictions?
No, you can withdraw for any reason. You could do it, take your money and blow it in Vegas. You can do absolutely anything you want with it. It's like J.G. Wentworth. It's your money. Use it when you need it.
You skipped one. There was a question from Renee. She said, I would like to get insurance on my mom. Do you offer that service?
So yes, we do. So we offer insurance up to age 84, I believe. Obviously it gets much, much more expensive the older you are. You know, one of the biggest things we do is actually policies on juveniles. I have a 2-year-old son. It was one of the first things I did for him. We could do it after, you have to be 14 days old, but it guarantees insurability and it gives them a lot of growth. But to answer your question, yes, you can absolutely do it for your mom. It's something we do very often, and it can be a great way to help create a legacy for yourself.
Hetsa, is there a minimum amount that we need to start using the whole life insurance? What is the amount of the coverage on that amount? Is there a minimum?
So the minimum policy we could do is $40 per month. Generally, depending on what you're using the insurance for, you're going to have we're going to structure the premium differently. So one of the most complicated things when it comes to life insurance, and I believe it was Nicole who is the accountant. She could probably speak even more to this than I can. But there's something called IRS Code 7702, which allows us to grow cash value within the life insurance policy and do it tax-free. So because of that, we have to structure the policy the right way to have it really grow cash value for you, which we're very careful about. But we can do a minimum policy we could do would be generally about $10,000 in benefit, would be about $40 per month, depending on someone's age. And we go all the way up into, multi over 10 million that we can do in coverage.
Okay, I think that is all the questions, right, Quinella? Did I miss anyone?
No,
I
I
have a
don't think
question.
Sure, Kasim.
Okay.
I wanted to know, how can you use life insurance and real estate? Like, what are different ways you can use?
Great question.
Okay.
So life insurance complements real estate very, very well. One of the reasons that people don't do it more is you want to set it up years in advance before you're going to start using it, at least around 10 years in advance. But because life insurance is, one, not tied to your bank account, I know a lot of people that when you're going for a mortgage, they'll pull the down payment from their life insurance policy because my policy will continue growing even when I pull out that down payment. And you kind of create a cycle where I invest in a property, I put, let's say, I pull $60,000 from my life insurance policy, put that down on a property. My policy continues to grow while I now have this new real estate property that I'm investing in. As time goes on, when I sell that property, I make my profit. I then put that money back into my life insurance policy so it can continue growing. And I'll kind of use that cycle often. But people like it because rather than pulling that money out of a savings account, where when I pull it out, it stops growing, I'm able to pull it out of the life insurance policy, have my money continue to grow while I'm now growing it in another area. And it kind of lets me double dip on that money at the same time. Similar to using like an S-block loan or a HELOC.
Got
good
it,
one.
got it. And does it have to be 10 years? Can it be like two to 3 years?
I would love to say yes, but the truth is it really wouldn't be less than 5, unless if you're able to really overfund the policy, meaning you can do a fairly sizable policy very quickly, then we can get it to a point where you can use it a little bit faster. But you'd have to be able to put in a large amount every month early on. You know, $1,000 a month plus.
Makes sense. Makes sense.
Kasim, I was gonna ask that next, so thank you for that.
But the right
Anna,
way to use it is definitely, you want to have about a 10-year period that you let it grow to kind of be more of a mature policy, so you can really get more of the benefit from it.
Anna shared or asked, I have my parents, one is disabled, and I wanted to do a life insurance for both of them. How much would the policy be per month? My mom is 65 and dad is 64.
So I could definitely get that to you. I would have to ask a few more questions. I would need to know a little bit more about disability, a little bit more about their health. But we definitely kind of being disabled on its own doesn't disqualify you from being able to get insurance. My father-in-law is actually disabled, and I was able to help him get insurance. We do a lot with special needs planning, with insurance. There's a lot we do there, especially with being disabled.
Okay, Ketsa, again, this sounds awesome. Thank you, Ketsa. I'd like to sign up for myself and my son. How can I sit with you or someone on your team to get set up?
Absolutely. So as a partner with the company, I actually don't have my own clients anymore. I help my team, I help them build their practices, but Diana is an advisor with us. She'd absolutely be able to help you. And for anyone here, I would be more than happy to take the time to sit on the meeting with you guys and help you out in anything you need. Just reach out to Diana. We can share her number and we can definitely set up a meeting.
Yeah, I'll definitely put in the chat. Ricardo, is there a growth of the cash value based on a particular interest rate?
I'm sorry, say that again?
Ricardo asks, is there a growth of the cash value based on a particular interest rate?
Yes, so there's a guaranteed interest rate on the policy plus the dividend. The guaranteed interest rate is, I believe, 4.55%. It's either 4.55 or 4.25. I have to double check. But that's in for the life of the policy. It's forever guaranteed. And then you have the dividend on top of that. On average, with both, what you'll see year after year is usually about 7% year after year. 7% growth on your money. The reason that's what it comes out to is there's also the cost of insurance that's going to come out of the policy. So let's say you have the 4.55% guaranteed interest rate and then a 7% dividend. That would be around 11.5%. The cost of insurance comes out. You'll wind up seeing about 7% year after year.
Thank you, Ricardo.
No problem.
Oh, Samsung, it's a phone, a beautiful lady. I can't really see her that well, but are there any limits?
Her name is Christina Marie.
Christina Marie is asking, are there any limits on precondition to get approval?
So absolutely. You know, one of the reasons that not everybody does this is you do have to get approved. There's an underwriting process. You have to be healthy enough to get the policy. We do a great job of trying to get anybody approved. We actually have, we have what's called a reinsurer, where even if we aren't able to take on the risk of giving somebody a policy, we have reinsurers that will then go back and hopefully take on the policy. We very rarely get declines unless someone has, a current illness, but, for the most part, we're able to get somebody coverage. Okay, Christina, you're an insurance broker. So absolutely. Oh, so are you asking about specific preconditions?
You may want to unmute yourself if you want to be clear on your question. Christina. Or maybe she
Hi.
can't.
Okay. Yes. I'm
Hey,
sorry.
Christina.
I'm using a phone, girl. My laptop died. I am so sorry. Okay, so I know certain companies, I'm not too familiar with New York Life, but I know certain companies when I first started years ago, that certain companies do not insure people with cancer or kidney disease, or so I wanted to know, like, because the elderly is, they have a lot of
Yeah,
conditions,
absolutely.
you know.
So we insure people, they can have cancer as long as they're 5 years in remission. So there are certain things that we'll want to see. If someone was currently diagnosed, then that would probably be a situation where we would not be able to get them insurance. With kidneys, we are able to do a lot, as long as it's not too severe, we're able to get them approved. What companies do you broker through?
So I do Mutual of Omaha, Kansas City Life. What else? National Group Life. Um, uh, that's just a couple of few that I use. It's over 25. Yeah,
So
it's over
I would
25.
say we're
But I know
probably the
Mutual
most
of
similar
Omaha
to
too.
companies like maybe Prudential as far as our underwriting tolerance, maybe like a Mass Mutual, very similar risk tolerance.
Okay.
But
And
we
Mutual of
also,
Omaha, I know do, but I wanted to know about New York Life due to the fact that, yeah, do give dividends as well.
right. So that's what I was going to say is, we offer a lot more than some of those companies, but
Mhm.
we also have something called Crump, where if somebody comes to, have you heard of Crump before?
No.
So even if somebody isn't able to get approved through New York Life, but they have a major insurance need and we want to help them with something, then we have over 50 companies that we're able to basically shop that coverage around to be able to help them get coverage somewhere, including Mutual of
Okay.
Omaha, Mutual of Kansas, Prudential, John Hancock, a lot of the companies that you probably work with.
Okay. All right. Just wanted to know. Thank you.
Absolutely, no problem.
And our lovely Martine asks, do you insure people with diabetes?
Yes, we do. So there are definitely certain specifications when it comes to A1C levels, what type of diabetes, things like that. But we absolutely, someone with diabetes can get insurance. We generally want to see an A1C under 7. The further under 7, the better it is. But we want to see that it's under control and, the A1C is good, and then we would be able to help you.
Right, I think that's it. As far as the chat goes, does anyone else have any other questions?
Well,
Okay, it doesn't
I'm
look
gonna
like we
put-
have any other questions. Eric, you want to wrap it up with something to encourage those listeners that may have doubts, or some people are shy, or they feel like, I don't want to ask a question, it may be a stupid question to ask.
Absolutely.
Based on what
So
you're used to, anyone that is a little resistant or hesitant about moving forward, is there something you can say to add to what you've already discussed?
absolutely. So our process, we try and make it very, very relaxed. Our first initial meeting is generally an introductory meeting where we're going to talk a little bit about what we do and how we help people, somewhat similar to what we talked about today, but that's where you can ask very general questions and we go at your pace. So the more you want to talk about, we can help you. If there's certain things you want to keep off limits, we don't have to always go super in depth. But what I'll do for you guys, I'm going to share my contact info. Only because I know also some of you guys, you have a personal relationship. I know some of you might know Diana personally. It's not always super comfortable to share very personal information with somebody you know well. So if anyone has questions you weren't comfortable sharing in a public forum, feel free to reach out to me directly. I can answer any questions you might have or help you in any way you need. And we can keep that completely confidential. So I will share my info here. That's my cell phone number, my email address. Feel free to reach out to me. Just reference the Q4 Mastermind that we spoke here. This way, I know where we met, and I'd be more than happy to help any of you guys with anything you might need.
Thank you so much, Erik and Diana, for your time, sharing all of this information with us, even putting this presentation together for us to follow along and really like understand what whole life insurance is all about and the benefits of having insurance even while living. Many people think life insurance only relates to death, right? But there are a lot of other things to gain from having these policies. So really appreciate you breaking that down for us. I again thank you all for joining us, attending tonight's session, tonight's webinar. I look forward to seeing you all again tomorrow. We will be discussing the land bank with the land bank team. You can purchase deeds for as low as $300. So for those who do have life insurance or we're going to say you're going to get set up with life insurance, and maybe some of you can't pull anything out for the next 10 years unless you're bold and gonna do a monthly policy of $1,000 a month. They can do it sooner. This is what you want to do with your money. If you plan on investing in real estate, this is a great way to start. Again, Erik, thank you so much for your time. Please take down his information, Diana's information, connect with them. I'll be sharing their contact information via email for you to have as well. So no worries if you lose the chat this evening. And Erik, Diana, I'll make sure you have their information just in case anyone gets lost in the spam. You know how that goes. So the information will be sent to you directly. The inquiries be sent to you directly. Thank you all again. Have a wonderful night. And again, I see you tomorrow, same time, 7:00. See you.
Thank
Thank
you,
you so
everyone.
much, Gail, for putting this together. Thanks for having us. And
No
absolutely, guys, it was
problem.
great meeting all of you.
My pleasure. My pleasure.
All right. Have a good night, everyone.
Good night. Bye, Festa.